Yeah, Matt, good afternoon from a fairly wet Sydney. Yeah, look, there's a lot for global financial markets really to be absorbing, particularly on this geopolitical front at this point in time. But it's been interesting to see that we're only a couple of days past where the US markets hit new all-time highs. So equity markets, from a risk-on perspective, they're not ignoring these issues, but clearly the biggest issue or bigger issues is those fund flows and into where growth and earnings is. On the other side of that, dichotomy is the fact that we've seen that very strong rally in US bonds. So again, a bit of a rotation into defensive. So this is quite a little bit confusing to some extent for some investors, I think. We're starting to get a bit more defensive, Matt, understandably so, both on the timing of where we are in the cycle. Obviously, in 10 years of expansion in the US, which would suggest we're nearer the end of the cycle than the beginning, but that may still take a couple of years really to play out. And in the very short term, these geopolitical issues you've just been talking about clearly are on the forefront of a lot of people's minds. We do tend to think the G20 is really the main game here, and obviously really the whole G20 is going to be overshadowed by the prospect of this meeting between President Trump and President Xi and the potential outcome, or certainly signals, of the reinstatement of serious negotiations on trade. And if we don't see that, that might be some risk for markets overall. So in this rally, we've been taking a little bit of money off the table.
All right, what about easier policy from global central banks? Because that would, you think, have to be the other main factor that market participants are dealing with. We had President Trump overnight tweeting again that the Fed should cut rates, and markets and the economy would have been doing a whole lot better if the US Fed had not hiked as much as they had done. In Australia, it looks like market pricing is for another cut in July. So how do you get on the back of then cheaper money? That's obviously a positive for markets.
Well, this is the conundrum for investors, isn't it? Particularly those chasing income and yield, where you've got central banks really keeping the interest rate environment extremely low. And as you said, even here in Australia now, our interest rates are bound to come off again at some stage, whether it's July or August. So that chase for yield and income is certainly a focus. The other side of it is, obviously we've seen a couple of key sectors that are interest rate sensitive have been performing particularly well. We've seen good rallies here in Australia, for example, in the telco space, in the utilities, and in particular in infrastructure. And we'd certainly expect those sectors to continue to rally on the back of this. But central banks are clearly mindful that we're seeing a slowing of global growth. Obviously, we saw some early green shoots in the first quarter of this year, but that momentum just is not continuing. If you look at industrial production growth and PMIs are all softer, and that's got to be a bit worrying for central banks. So no wonder we're hearing some conversations and maybe some bias towards either further easing and certainly more stimulatory action.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.